the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning into Money FM 89.3. Time now for Market View, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of how we started. Well, Singapore shares tumbled an early trade this morning, joining Asia-wide declines as U.S. markets dropped deep into the red on fears over tariffs and recession risks. Now, the Straits Times Index was down 1.5% at 3,839 points earlier after some 71 million securities changed hands in the broader market. Now let's take you through the closing numbers. The STI ended deeper in the red, down 1.88% at 3,825 points. So in terms of value turnover, we are looking at 2.34 billion Sing dollars. Gainers trailed losers 220 versus 341. Top advances for today we've got for UJMX USD, New Incorporation USD and PC Partner. And top decliners we've got your DBS, UOB and OCBC, the trio of local banks. Now, in terms of companies to watch, we have for you SGX, given the local boss's plans to list Bitcoin perpetual futures as traditional exchanges push deeper into crypto derivative markets. Now, elsewhere, from a sell-off in local bank stocks to how talks between the US and China are reportedly stuck at lower levels, we've got more corporate and international headlines in focus. And joining me on the line today is Thilan Wickramasinghe, Head of Equity Research at Maybank Securities. Thilan, how are you?
I'm great. Great to be on the show.
Great to have you on board. And Thilan, let's start with the U.S. this time around. Growing worries of a recession in the U.S. appear to weigh on investors, given that sharp sell-off on Wall Street overnight. Now, the Nasdaq in particular, I believe, tanked 4% owing to another plunge in your tech titans, including Apple, Amazon, and Tesla. How concerned are you about the pessimism reflected in U.S. equities? How did Asia track those movements today?
Well, the U.S. Treasury Secretary did say the U.S. markets are going through a bit of a detox. It certainly feels that way. Look, valuations are expensive and the U.S. markets have been frothy for a while now. The mood amongst investors have turned nervous with the tariff war, government spending cuts, and some pretty weak macro readings coming through from the U.S. as well. And we have seen that contagion coming across to Asia, with Asian shares falling to a 5-week low at one point. These declines did trim a bit as the day went on. By midday, essentially, Hong Kong and China did see a little bit of a comeback.
Yeah.
I think really that's the interesting angle here. We are seeing investors rotating to Asia and especially to Hong Kong and China, given how beaten down these markets are, even after the recent rally. And the expectations are that the government, the Chinese government, will continue to pump prime and bring in strong measures to stimulate that economy. So we are also seeing some domestic support coming in from mainland Chinese investors buying unprecedented amounts of equities in Hong Kong as of Monday. So we think the U.S. may see some of their overcrowded trades unwind, and Asia may actually offer some relative safety while that happens.
Right. And going back to the Singapore stock market as usual, Thilan, how has the STI fared today in relation to global markets? I mean, down nearly 2% at the close. Any surprises when it comes down to the banking sector as well as sell-off in the trio of local banks?
Yeah, so I think the overall STI is down, led by the banks. But we did see some pretty strong, movements from the REITs, them coming back. Most of the top gainers today, if you actually look at them, were the REITs with FCT, CICT, Mapletree Industrial, Impact, MLT, and Ascendas REIT, all in the green today. I think this is driven by the expectations of rate cuts happening sooner rather than later, and that's a dramatic change that we have seen over just the past few weeks. We also saw Jardine Matheson up, closing about 3.5% higher. Again, I think mostly driven by expectations of a North Asia recovery. I think the banks clearly were the biggest losers today. I think that some of this is profit-taking given the very strong run you've seen in the past few months for these banks. The dividend upside is now a known with some very clear capital return policies expressed by management. And as I mentioned earlier, we think there is rising expectations of Fed rate cuts amidst all these U.S. macro readings. This is raising fears that net interest margins of the banks will fall faster than what was initially expected. So even expected just a few weeks ago when the results were released. So while we think the banks still offer some fundamental value, there could be a period of consolidation until there's some better clarity on exactly how and where interest rates will go.
Let's take a look at some of the other counters to watch on the SGX. Thilan, we have the Singapore Exchange. Given the bourse operator's plans to list Bitcoin perpetual futures, and this is, of course, as traditional exchanges push deeper into the crypto derivative markets, and the move is also seen as a sign that established exchange operators, they are branching out into Bitcoin derivatives because U.S. President Donald Trump's his pro-crypto agenda is boosting demand for digital assets exposure. How would you assess SGX's latest move, though?
Yeah, I think it's a move that aligns with a lot of other established exchanges entering the Bitcoin derivatives market. We have seen a growing demand for these instruments, and there is a pro-crypto sentiment that is rising amongst institutional investors, especially given as you said, the friendlier policies of the Trump administration. These perpetual futures products, they don't have an expiry date, and they're fairly similar to the products that are offered by some of the offshore platforms like Binance and OKX. I think the unique selling proposition for SGX is their Moody's AA2 high investment grade rating. This should give investors a lot more of a more secure alternative than some of the more unrated exchanges out there. Plus, I think one good thing is that these are accessible only to institutional and professional investors, which creates some safeguards as well. Overall, I think crypto derivatives like Bitcoin should see more and more adoption from active professional investors going forward.
And staying in Singapore, right, Thilan, another counter to watch is DFI Retail Group, which is part of Jardine Matheson, because the supermarket and retail store operator behind our Guardian and Giant supermarkets, it posted 29.7% rise in underlying profit to $200.6 million USD for the full year ended December. Up from just $154.7 million USD in the previous corresponding period. How far is this within your expectations? How does this filter through to the earnings we saw at Jardine Matheson, though?
We don't cover the stock, but the revenue seems to be coming in slightly below consensus estimates. We did see that the reported profits actually swing to a loss of around $244 million in 2024 versus a slight profit of around $32 million the year before. The losses, though, were largely non-cash, with charges being taken for their divestment of Yonghui, impairments for Robinson Retail and their Macau and Cambodia food business. Importantly, if you take DFI's net cash position, that's actually gone up, and that's actually quite good, especially after the Yonghui sale in February. And we also did see some bright spots, especially in Singapore, where we did see that earnings recovery is coming through on the food segment, and the product mix also in the convenience store business is moving more towards non-cigarette category, so that again is good and much higher margins. We did see a little bit of weakness in China, but not too much, and I think that's something that probably can turn around as a lot of these stimulus efforts come through. They have actually declared a higher final dividend than last year, which I think is actually a positive read-through to Jardine Matheson as a whole goal.
And Thilan, in Singapore, developments surrounding financial services firm Chocolate Finance remain at the top of minds of investors. What are the broader implications on the fintech industry per se, or in the longer term, or would you say it is fairly company-specific, it is fairly contained at this point in time?
I don't think it's a systemic issue, especially if you look at the broader banking sector in Singapore. I think they have a bigger problem with excess liquidity and excess capital, if anything. I think this is more of a company-specific issue, and I think you're going to see that happening from time to time. And I think there was some unclear communication with customers, which drove them to withdraw funds. Since then, we have actually seen the company come out and clarify the situation, and there also seems to be some clarity that customer withdrawals will be processed in alignment with industry standards. So you won't get your money instantly, but you will get them within a certain number of working days. So I think to us, it's more of a public relations issue than a solvency issue. And I think as fintechs rapidly evolve and test their business models, you're going to get this sort of news flow from time to time.
And just a curious follow-up question: do you think this is more of a representation issue as well, even though that's still to be seen down the road?
It's more of a representation issue. I think there was definitely a communication issue in terms of how it was communicated. So I think that's something that I think we've seen MAS also saying that they're looking into. But I think overall it's more of a public relations issue and a communications issue than a solvency issue.
Okay, now if you're just tuning in, we're now in conversation with Thilan Wickramasinghe, Head of Equity Research at Maybank Securities. Well, across the region, Thilan, talks between the US and China on trade and also other issues are reportedly stuck at lower levels, with both sides talking past each other and failing to agree on the best way to proceed. Now, as investors, how concerned should we be about this against the global backdrop, particularly when we look at the implementation of tariffs on all U.S. aluminium imports starting tomorrow?
Yeah, I think there is some uncertainty as to what the U.S. actually wants from China. The meeting of the lower-level rankers is actually a symptom of that. On one hand, we have the U.S. slapping tariffs on China, and on the other hand, we have President Trump calling for more investments from China to come into the American heartland. So I think for investors, there will be heightened uncertainty for the time being. I think any signs that we can look forward to where President Trump and President Xi officially meet could be actually seen as a positive response. But I think that for that to happen, there needs to be some clarity as to what the U.S. actually wants from China. If such a meeting does happen, I think that will indicate that a number of issues have been ironed out by the lower level staffers. And you can see, and you can already see China keeping their door open for what, from all the tariffs that the U.S. has put in, with fairly measured responses so far. Having said that, and I repeat that again, until we see a coherent policy from the U.S. on their outlook to China, what they actually want from China, I think there will be a lot of uncertainty around this relationship.
And speaking of uncertainties, before we let you go, Thilan, some changes at Nissan right here. The latest news is that its CEO, Makoto Uchida, will step down from his position on the 1st of April, in fact. But apparently Nissan Motor reportedly also wants to be directly involved in the development and the rollout of new products in a potential tie-up with a new business partner rather than just serving as a contract manufacturer. Now, how would you read into that? Any quick thoughts on the matter?
Nissan has not had the best of luck lately. It has an aging lineup of models, and its early lead of cheap EVs are overtaken by the Chinese manufacturers. Now, as you said, the CEO has stepped down. Now, a tie-up with a big tech firm does have some positive merits. Just look at Xiaomi's EV. It looks great, and it's very popular with buyers. We're also seeing Google's Waymo robotaxis gaining a lot of traction as well. So I think for Nissan, a relationship with a big tech firm can really help them stand out. I mean, I think in a very, very crowded space of EVs, you need something that will help you stand out. So if that happens, that's going to be very positive. Execution, though, is something that we will have to watch out for, especially with all these management changes.
I see. Lots to watch indeed. Thanks so much for the insights, Thilan. That was Thilan Wickramasinghe, Head of Equity Research at Maybank Securities. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.